Hi everyone, welcome to the channel. Now before I switch over to my screen share and walk you through all of the charts and all of the data that I know most of you tune in for, it's been a wild few weeks, a lot has happened. If you picked up our analysis over the last couple of months, you'll already know that it's been very much a risk-off environment. Everybody is asking if the market has potentially bottomed, or is the credit event collapse that everyone's expecting just around the corner. Investor sentiment at the moment is showing that there's a lot of fear, there's a lot of negative news headlines. So this week I'm going to walk through a high level market deep dive, and as always I have some individual charts, individual names, ETFs from my chart books that I have prepared as well. Now, over the last week, we've had interest rate hikes. Everyone's most hated grandma, Janet Yellen, talking. We've had a potential banking collapse, which is on the horizon as well. Lots of other news-driven events. It is very, very challenging, but I'll do my best to filter out all of the noise and present the charts and the data that I believe matter. Now, for disclosure, some of the charts that I will be walking through today, myself, my clients may already hold some positions in those names. As most of you know, I do not use the magical hindsight indicator. I timestamp all of my work, which is incredibly important for the field in which I work. And although I do use technical analysis in combination with company fundamentals, I'm definitely not a short-term day trader. I'm not looking for short 5-cent, 20-cent moves. I'm in it for structural trends, process-driven, systematic, trend-following principles. And I'm looking for trends for weeks to months at a time. And I'm told that my charts are among the cleanest in the business. My work is very well known in the professional game for my ability to highlight the big risk on, risk off turning points in the market. And like I said, my time-stamped work is all there to view. Some of my recent time-stamped calls, the crash 1 year ago, the rotation in 22 from growth to value, the bear market rally in June, the top in August, the top in the US dollar, the bottom in the market in October, and of course the bottom in bonds and the recent rotation into technology names as well. And if you want to go a little bit further back, I did accurately get our clients defensive ahead of the 2020 crash as well. So I do have a track record of being mostly correct, which obviously helps in this field. And if you do find some value from my work, feel free to like, share and subscribe on YouTube, and feel free to follow me on Twitter, where I post charts most days. Enough about me. Let's dive into some charts, but please pause the video, make sure you're comfortable with that very important disclaimer before going any further, and let's dive into it. Thanks. Now, I think a good place to kick things off is to start by just quickly touching on the yield curve. Now, the yield curve has, in my opinion, probably now bottomed. We are starting to see the numbers move to the upside. Now, there's a really good chart that was shared this week by Steven Straza on Twitter that I think highlights just exactly how we can use the yield curve in combination with the S&P 500. Now, it's of course not a prediction, but what it does offer is some kind of insight into how we might think about managing risk in the current environment. I think it's very, very difficult to make a bullish fundamental case for the market in the current environment. But with the charts that I have to present this week, some of you might be taken aback because I am seeing the signs and the early signs of rotations to the upside in some areas of the market. And of course, like always, there are always areas that we are bearish on as well. But I think for those of you that maybe are bearish in the market, I think you're probably looking at a chart something similar to this, where we have the various stages and we're just looking for the blow off, capitulation followed by despair. Now, central, in my opinion, to the whole bear case in the current environment is, of course, the financials. Now, this is the chart for XLF. Now, we can see that we are at very big levels dating back to the financial crisis. These levels have acted as resistance and recently support. And what has caught my eye over the last week is the Economist front cover, What's Wrong with the Banks? Now, some of you might not be aware, but The Economist is a bit of a running joke within the technical community because they are wrong constantly. And whenever you get The Economist front cover, we can usually use it as a contrarian signal. So potentially The Economist is nailing it again. They're expecting the collapse of the banking system. I'm not quite in that camp at the moment. I understand, of course, there are lots of negative headlines, especially coming out of Europe over here. Deutsche Bank, Credit Suisse, and of course Silicon Valley Bank, etc. in the US. But for me, central to the case, if XLF dips below $30, then the world is in a lot of pain when it comes to the markets, in my opinion. I think this is the chart to watch at the moment. There's not a lot that we can actually take from the major averages. I've highlighted these charts over the last few months, that we are approaching big levels, and it would be very, very logical and normal for the market to, one, digest some gains, and two, give us a little bit of chop. I think we've probably seen both. So there's not a lot that we can currently take from the S&P 500. Of course, if you picked up our analysis last month, if you've been following my work on Twitter, you'll know that I was very early on this chart, really just highlighting the failed moves. We are chopping around the 200-day simple moving average at the moment, but in all honesty, folks, that there's not a lot that you can take from the S&P 500 chart. There's no direction. It's not predicting any direction. There's not any trends. So this is the type of environment where you need to dig a lot deeper. You need to be going in and having a look at all of the individual sectors, all of the individual charts. The same story with the Dow. We've been communicating to our clients over the last few weeks that I'm looking at the 200-week simple moving average to act as some kind of potential support for price, just as it has done dating all the way back to 2011. Of course, the outlier there was the COVID crash. The small caps, and just for complete transparency, what you'll find with a lot of the charts this month is highlighting just exactly what I've been communicating to our clients in real time. I don't want to be the analyst on social media who's using magical hindsight indicators. Called the top here in the small caps on the 22nd of February. Again, we've met downside objectives, but now it's really just a waiting game and seeing what happens. The micro caps have been threatening to fall off a cliff. I don't think that would be particularly bullish for areas of the market. We've seen a massive outflow from a lot of the riskier small cap, micro cap names. They've just not been an area that you've wanted to touch over the last few months. And of course, we all have to keep an eye on the 10-year Treasury note yield. But one thing that I think many are perhaps missing with the 10-year Treasury note yield is that if this breaks down, there is a very strong inverse correlation with technology. Now, I am going to be touching on technology in quite some detail over the next 10-15 minutes. But I think this is a really good chart just to highlight the inverse correlation, because everybody is super bearish on all areas of the market. You just have to look at some of the semiconductor moves. They've been ripping higher since October, which has been great if you've been invested. But I also understand the other side of things, where I think many have probably panic sold and maybe just haven't bought in and taken advantage of these massive rallies that we've been having. And I get the frustration out there, I understand it, but at the moment, if the 10-year note breaks down, for me it's very, very logical and normal to see technology move higher. We can look at XLK. The market has just closed on Friday. We've got now fresh closing 6-month highs in XLK. So again, that's information I want to pay attention to. I'm not saying that I am bullish on the market or the economics of the market by any stretch of the imagination. I have the same concerns as everybody that is watching and listening to me just now. But what I do have an understanding of is that money has to be parked somewhere. The institutions have to park their money in areas of the market. And I think at the moment there's signs that we are starting to see the parking in technology names. The triple Qs, in my opinion, are basing. I think there's a 10-month base here. We can look, I'm using basic Fibonacci retracement levels. I think if we break above these levels and confirm this breakout, again, that would confirm my thesis that we could potentially see mega cap tech move higher from current levels. We can see it on a relative basis as well. Again, for those of you that picked up my midweek letter where I did touch on this chart, just highlighting that if we do break back up above these 2000 highs, then again, this would lead us to suggest that tech is poised for a period of outperformance. Now, of course, it all knits together. We need to pay attention to financials. I think if financials fall off a cliff, it would be very, very normal to see technology follow suit. But I think if the financials hold up, then again, I think technology is an area of the market that you probably want to pay very, very close attention to. Now, I am going to walk through around 15 individual names and ETFs that I think you can add to your radar for the next couple of weeks. But if you are still here, it probably tells me that you're getting a lot of value from my analysis. So it would mean the world to me if you hit the like button. Let me know in the comments, what charts am I missing? What charts do you think are poised to move higher? Do you think the market's about to fall off a cliff? Let me know in the comments. I'll do my best to get back to you. But everybody and their dog is really trying to pinpoint the US dollar index. Now, for me, the US dollar index is in a very structural uptrend. The textbooks tell us that we have primary trends and we have secondary trends, and then we have the third trend, which then is a continuation generally of the primary trend. So I'm looking at it through the lens at the moment that the US dollar index could potentially move higher. We all know that there's a correlation. I'm assuming everybody knows that there's a correlation between the dollar index and volatility. So really, if the dollar index is going to go higher, the recent correlation with volatility would suggest that volatility could go higher as well. We just need to have a look at the market today, whipsaws back and forth, but the market ultimately closed higher. That's an environment where you just have to take away the intraday moves. I would highly suggest and recommend checking the market, the first hour and maybe the last hour, and everything else in between. Just treat it as noise. If you don't watch it, you're not affected by it. That's the way that I'm looking at the market at the moment. And of course, we've got the bond market volatility already exceeded the COVID crash levels as well. So I am actually open to the possibility that the volatility in the market is topping. But again, going back to the chart at the start, I think it all comes down to financials. And of course, we've got the credit spreads and volatility as well, which have been moving in tandem. But obviously, credit spreads have started to move lower. So I would hope to see volatility move lower as well, because it just makes for an easier, stress-free life when the volatility is on a decline. But everybody is trying to pinpoint the top in semiconductors. Now, Semiconductors, of course, have been ripping higher since they bottomed back in October, but the relative chart going back to where institutions are likely to park capital, a lot of the times that they're looking for outperformance, most of the time they're looking for outperformance, I should say. So if we've got semiconductors relative to the S&P 500 pushing up against levels dating back to 2000 and 2021, if the period of outperformance is going to stop, then we could reasonably expect some declines in semiconductors. I know there's many of you that are looking for tops in Nvidia, AMD, etc., which I will go over those charts in just a second. If those charts are going to decline, I think this is the levels that it's likely to decline. It's a relative chart that I'm using. It's not an absolute chart, because on an absolute basis, believe it or not, semiconductors tell us that there's 20% more upside here, but I'm actually keeping an eye on the relative chart, because I think it will give us a lot more information in the near term. But Nvidia, just for complete transparency, this has been a recommendation of ours dating back to the 3rd of January. It's been on a massive rip since then. I don't need to talk about that. There is still, in my opinion, 24-25% upside in the chart. But again, I think it comes down to the relative chart and obviously what happens on an absolute basis as well. If this chart breaks out in semiconductors, if you're short semiconductors, it's going to be a big problem. So certainly I would just urge everybody to just be open to all outcomes and possibilities. I never recommend jumping into names and charts, although I have 25% upside objectives here. The chart is quite extended from its moving averages, so I would never advocate buying in at these levels. But I get asked about Nvidia all the time, so that's my updated chart for it. Same with AMD. I think the chart here, I think if we could break out here above that 105 level, then again, I think that's a chart that might make some sense. A lot of my work in the current environment has really been based on buy low, sell high charts. Because the market's quite choppy and range bound, I've been looking for charts and stocks that are trading at the lower end of the ranges on big support levels. On the 3rd of March, for example, with AMD, using the 40-week simple moving average, the AVWAP from the January lows, and a confluence of support levels. And of course, we've met upside objectives, but the next level will be above that 105. We've got Apple breaking out. Again, this probably goes back to the thesis that I have that we could see capital parked in mega cap tech. I think if Apple's breaking out, I think there's 15% upside there. We're seeing the same thing with Google. Again, one of those buy low, sell high charts does look like it could potentially now be resolving higher. It has now broken above its 40-week simple moving average, and of course broken above big pivot level there as well. So that's one of the charts that I've got my eye on going into next week. Of course, Meta has been on an absolute rocket ship. A lot of investors, of course, wondering why Meta has been ripping higher. I think the TikTok potential ban is maybe on the horizon. I don't know the ins and outs of that, of course, but I think there's a big expectation and a lot of people are placing bets on that. Again, it's been a recommendation of ours since January, and of course it is continuing to move higher and break out above key levels. AI, again, got upside objectives there at $30. Today there was just wild swings in this one. I think it was up 7 or 8% at one point, and then I think it closed maybe up 1-2%. I need to check the numbers there, but again, we've got our upside objectives here at $30. Tesla, again, I think this level here around 210 will probably come into play. It has pulled back recently to its 50-day simple moving average. It is still in a bullish RSI regime. So again, this could potentially be one of those names that catches a bid over the coming weeks if we do see the rotations. Again, Amazon, is it potentially basing? For me, I think the 200-day simple moving average has been a problem over the last year. I think if we can base and break out above that 200-day simple moving average, then again, Amazon could be one of those names that catches a bid. Salesforce, perhaps above $200. Recently, I think, announced a massive share buyback, probably factoring in, if you look at the PE ratios, it doesn't make sense why this is going up, negative earnings growth. But of course, I think investors understand share buybacks, etc. So I think if this breaks out above $200, then Salesforce could potentially get moving. Again, Lam Research. Again, I think there's solid fundamentals there, reasonable PE ratios. We've got solid 12-month earnings growth in the current environment. I think 540 there is the next breakout level. Block. Now, I had a few messages on this one because I posted a chart to social media today just regarding Hindenburg's hit piece. Now, I don't really have an opinion on the hit piece by Hindenburg. Well written as always, makes a compelling case. For me, the chart is really textbook range bound. It's no surprise that there's a news event that's taking the price lower. Range bound charts do what they say. They move from the top to the bottom, from the bottom to the top to the bottom. So I'm looking at $50 as a potential level for block. But I understand for those of you that have maybe been caught out in the overnight gap down, it's probably a very frustrating one. I get it. But I think $50 would be the level where you'd probably want to see some kind of big rebound there. Now, quickly touch on the energy markets before I get into a few ETFs. We've got, of course, crude oil, which has just been annihilated over the last 6 to 9 months, flirting again with big levels. But rather than walk through the Brent oil and the oil markets, I'm actually looking at potential buy points for some of the recent beaten up names. Again, Chevron, 75 billion share repurchase program, really announced it's an annual 17.5 billion. So I'm looking at levels and building in levels where I could be looking to buy the stock. I think around $133, $135 makes sense there. It could absolutely rebound from middle of no man's land, and that's fine. But for me, I'm looking for these technical support levels to get kind of a really favourable risk to reward proposition. Same with Occidental Petroleum. The 13F filings show that Warren Buffett keeps buying at these levels as well. So I think as long as we're above these levels in Oxy, then I think you can remain bullish. But you don't need me to tell you that the chart just on its own is a massive sideways mess. But it might favour those of you that like the buy low, sell high, range bound charts. There's a very easy out. I think if you start to break below that, that $52 level, then that's probably an environment where Oxy is coming under a lot of pressure. Now, I've taken a few questions on this one during the week because this isn't the type of chart that I normally post to social media. But what I tend to observe, especially being in the professional game and comparing my work, I guess, across the board, is there seems to be this thing about relative strength and relative performance, and I've pushed back on that recently because you can actually find relative performance in stocks in areas of the market that have pulled back significantly. And let me just quickly demonstrate what I'm talking about here. We can see that this is a massive sideways mess. This is what I would just call an RSI chart, where you can reasonably expect a bounce, you can expect a pullback, etc. But what I like to do with these charts is then go and have a look at the relative performance, because these types of charts will never show up on anybody's bullish scans. But when you look at the relative performances, when we get these bounces, what happens? This is the relative performance compared to the S&P 500. So when we get to the low end of the range, what happens is we get these massive periods of outperformance. So I like to pay attention to this because recently lithium, which I understand not everybody is going to want to be an investor in that area of the market, but again, reasonable to expect a bounce. Well, if we can expect a bounce, let's go and dig into the individual names and the components of that ETF. On the 16th of March, we came up with SQM. What happens is SQM is low end of the range, a buy low, sell high chart. And of course, what happened is it ripped 17-18% in a matter of days. So these are the little intricate things that I like to pay attention to with my work. It's not all about breakouts and trying to time breakouts and moves in the market. We have to look for the beaten down areas of the market, and I think that's something that my work is starting to get really well known for, is identifying failed moves and failed breakouts and failed breakdowns. XLC, again, another one of those range bound charts. We've got an upside objective here. This is from our ETF chart book. It's $60. And of course, good old gold, which has just been a massive performer over the course of the last few months. Again, pushing up against upside objectives there as well. So there is a massive amount to take from the market at the moment. I'm not all doom and gloom. I think there are areas of the market that are looking quite constructive. Of course, there are areas of the market that are just being decimated, small caps, micro caps, etc. It's not really an area of the market that I find terribly appealing at the moment. But who knows, maybe in 6 weeks, 3 weeks, 2 weeks, those areas of the market will be buy low, sell high charts, but we'll need to see how things are. But if you are still here, please do, as always, hit the like button, share and subscribe to the channel. If you are wondering who I am and you've maybe stumbled across my work for the very first time, feel free to jump onto our website at honeystocks.com. We are doing a massive spring offer at the moment, so feel free to check that out. We provide memberships, annual, quarterly, monthly memberships to suit everybody. We provide premium weekend analysis like this every week, investment ideas, provide access to our midweek halftime report. We've got a wonderful investing community. We provide access to our chart books, our ETFs, our commodities, all our stocks. And of course, if you are somebody that's maybe in the process of learning a bit more about technical analysis, we also include with every membership complete access to our technical analysis program, and I'm told I've built one of the very best out there. So again, feel free to check that out. But let me just quickly show you what our high conviction trade ideas look like. This is a recent idea that went out for Tesla. Actually just a play on capitulation, really. Of course, massive performer this year. Meta, again, above 125, massive performer. This is the short idea. We are long and short. But I'm really looking for failed moves, in all honesty, when it comes to short ideas. But of course, the Russell 2000 has really dragged everything lower. And of course, that's been a massive winner as well. Netflix, again, big winner. Amazon had a good 12-13% move as well. And ELF, which is up at, this thing's up at nearly $80 now. There's a lot that's provided with my work, so feel free to go and check that out. I think my work is probably a good fit for you if you are maybe a mid-term in your approach. If you are a minute day trader and you're scalping and all that nonsense, then my work's not a good fit for you. But if you're maybe somebody that's looking to get away from that because you've realised that it's stressful, etc., and again, I think my work might be a good fit. Maybe you just want to be part of a community. Maybe you want to have access to a professional analyst daily. We provide chart requests whenever needed as well. And of course, maybe you're just too busy with work, family life, etc., to hunt around social media for all the stocks. But whatever your deal is, feel free to jump around our website, do your due diligence and see if my work would be a good fit for you. But if you've stuck around to the bitter end, thank you very much for watching, and I hope to welcome you soon. Thanks.